Unbelievable what is going on, guys. Unbelievable what is going on. Going nuts. The SPY is going nuts, guys. It's going nuts. I'll be looking to trade the reversal. Again, I'm looking at the reversal up here, waiting for profit taking. Man, I missed this. That's that reversal that I'm talking about, guys. I still want to be a little bit more patient. That would have been a nice, sweet ass money. Sweet ass lick. Damn, that would have been a good lick. I'm gonna be patient. This whipsaw was expected. I knew I should have played the reversal at the 518. I knew I should have played the reversal. I'm still gonna be patient and let the chart develop. Hey guys. I'm in the library, so I have to be a little bit more quiet. I didn't think it was going to explode either. I was late getting here. I found out at the last minute my location didn't have Wi-Fi, so I had to go change locations, and I missed this move with the breakout over our pre-market high and kept going. I wish I'd have took the put here at resistance. Still early, and don't forget that Powell speaks at 2:30. Unfreaking believable. Thing almost went a whole drama. Saying something can hear. It's choppy. Okay, I try to talk up a little bit, but I can't talk too loud. It's going to be a lot of back and forth right now. Oh, no problem, no problem. I'm looking at the 30-minute candle, 30-minute chart, and see that beautiful green hammer right before 2 o'clock.
The three priced in, a discussion around quantitative tightening. And I go back to what I said earlier in terms of the data points that he's paying attention to, because Chair Powell has shared in whether it was congressional testimony, some of the other conferences, he has shared the fact that he is anticipating rate cuts this year, that we don't have to break employment to actually get our first rate cut. And just to put all of this into perspective, we're talking about 3 rate cuts of 25 basis points. Those 25 basis point cuts are far from accommodative. And so I think we also just need to put it into the larger context as well.
John Bellows, a final thought. You know, David highlighted the risk with regards to reserves. I think the other side of this is the point that was made, is they bought a lot of bonds in 2020 and 2021. You know, they expanded the balance sheet tremendously. And I think that's going to mean that their bias is going to be to continue the QT for a while and try and get that back down. Again, they bought a lot of bonds. There's a long ways to go to kind of undo that. And so I wouldn't be holding my breath for them to start buying bonds again.
So use liquidity as an excuse to stop.
potentially.
Steve,
Rick,
you go ahead.
Rick, what's the bond market want to hear from Powell when it comes to QT? Obviously, they want to know that there's a whole bowl of lollipops that are out there, which is,
well, 10-year note yields are already thinking about this.
Okay, go ahead. Tell me what they're thinking, Rick.
They're moving higher, and here's what they're thinking. That quantitative tightening is going to stop well shy of any number. We're currently at what? 7.58 trillion. Last time we got as high as credit crisis, 4.5 trillion. We came down to 3.75 trillion. So the spread of where we're going to stop is going to be wide, and it's going to stop because of the notion that the reverse repo parking lot's getting empty, and the bond market doesn't like if the balance sheet is much higher, in my opinion, than 6 or 6.5 trillion, which in and of itself, as you pointed out, is still 2 trillion higher than when they stopped after the credit crisis. And you know they want to use that balance sheet again should any type of crisis develop in the future. And we all know the crisis calendar seems to have a higher frequency than it used to.
How did I know that Rick would have an opinion on the balance sheet, guys? How did I divine that?
Familiarity, history, a long and glorious history. Thanks, guys and ladies.
Thanks.
Appreciate it. All right, coming up, we'll get more reaction to the Fed's decision. And we're just minutes away, of course, from Jerome Powell's press conference. We'll take you there live when it begins at hour. But first, a quick break. Stick with us.
I am in a put. I repeat, I am in a put. Cancel. Damn. There we go. That's what I was waiting for. I will take profits right here at the 516.2. I'm taking profits at 516.2, guys. Where I got this bar at. Watching the clock. 2 minutes left on this candle. Slow. I was slow on that profit taking candle. Again, nothing is exact. We're talking about an area. Everything is happening very quick right now behind the FOMC.
Welcome back to Power Lunch, everybody. The Fed leaving interest rates unchanged as expected and sticking with an earlier forecast of 3 rate cuts by the end of the year. Here for his reaction is our friend Dennis Lockhart, former Atlanta Fed president. Mr. Lockhart, good to have you back with us. I guess I don't see much in the statement or the action, which is a non-action, to suggest that the Fed is becoming more hawkish. I'd like to get your reaction to that. But I do sense that maybe they're just becoming more patient, which is not necessarily a bad thing.
Yeah, I think your conclusion is correct. I would say, however, if you look at the dot plot, you do see some movement in the dots. There were, I think, 4 dots. That is 4 moves, and they have all but one have moved into the 3 category. The consensus is pretty tight, around 3 moves this year. And I think that's the takeaway, that the consensus has tightened.
What about the big boost to the GDP forecast?
All right, quick profits for taking there. Very quick profits.
What do you make
and
of that?
out.
And is that sort of the Fed setting themselves up for saying, look, the economy is getting stronger. That's why we've got these 3 cuts planned?
Yeah, I think they're recognizing that the underlying demand in the economy, the underlying strength is pretty robust, and that's why I think they're sticking with 3 rate cuts, because they see that they have that strength of the economy to deal with.
Take us inside the meeting. Since the last meeting, we've had a couple of inflation numbers that have been, to some, a little bit worrisome. What is the discussion like about numbers that were above what Wall Street?
Good job, Lance. Good job. Way to get some money with me. Way to get some money.
They're not dismissed, but they're looked at in the context of being, just one report or 1 or 2 reports. So there's not generally not an overreaction to that. I think, as Jay Powell has said frequently, there's no expectation that this disinflation will be linear and it just will come down in an even fashion month over month over month. So I think they reserve judgment, and I believe that the reports we've seen recently, to a small degree, reset the clock, because they need to look at another 2 or 3 months of inflation reports to be sure that what they're seeing is just a bump and not something that's signaling a real change of direction.
And that's sort of what I was going to ask, is how many reports do you need to see in a row to consider it a pattern
All
for
right.
inflation?
Good job, Dr. J.
Inflation has sort of been
everybody.
this sticking point. And how do you know when it's just a bump or it is a new trend that the Fed should take appropriate action on?
I think different members of the committee might have different answers to that. I would personally say I would be looking for 3 to fully interpret what's gone on with the January and February reports. So it would be, past, in all likelihood, past the May meeting.
Is there an unemployment number? Rick Santelli just mentioned the idea that unemployment is about a ½ point higher than it was at this time a year ago. His prediction was that it may go above 4% on the next number that comes out in about 10 days. Is there an unemployment number that would cause the Fed to begin to worry about that? Because full employment is part of its mandate.
Well, first, there are good and bad reasons why unemployment numbers rise. When you have people coming into the workforce and increasing participation, that's a good reason for the unemployment rate to rise. So they would look within the numbers to see what the dynamic really is. But if you're seeing layoffs and you're seeing widespread downsizing of companies and so forth, beyond 4% would begin to, I think, get the attention of people on the committee.
How do you characterize the economy that you see? The Atlanta Fed has typically been sort of one of the more ebullient forecasters of economic growth. What do you see around you?
I see a solid economy that is slowing from a very, very strong third quarter of 2023, somewhat less strong but still strong fourth quarter. And this quarter, if you believe GDP Now, the Atlanta Fed's tracker, is coming in around 2%. So that's a slowing top line growth number. I see a very healthy labor market, and I see inflation going sideways at the moment. So there's a bit more ambiguity around the total picture, particularly the inflation picture, than we would have had 2 months ago, for example.
Mr. Lockhart, always a pleasure to have you with us. We thank you.
Thank you.
Dennis Lockhart.
We are just moments away from Fed Chair Powell's press conference. We will take you there live as soon as it happens. Been anticipating this all week. Power Lunch is back in 2.
Okay, guys, we're back into that lull. I do apologize because I only wish I was here early enough for us to have taken advantage of this, because this move broke out above our pre-market high, and not only that, it came off a very beautiful shooting star on the 30-minute chart. So if you look right here on the 30-minute chart, we were consolidating a little bit of a downtrend, but to support that, we also had a area of support. We had the green hammer. It broke out over pre-market highs, went all the way up to the 518. I was very hesitant to pull the trigger when I knew I should have gotten the put right here at resistance, but I didn't. But instead, we still were able to make some money, so I'm grateful for that. We knew this was going to be some fast action today, and what we'll do is just prepare ourselves for tomorrow morning, depending upon how the market reacts and responds up until the close. But as far as the roller coaster ride, we had a ride up, we had a ride down, and now we are consolidating. And we're also above VWAP. So let's keep that in mind. When the stock price is above VWAP, it has more of a tendency to be bullish. We also know that there are a lot of bulls who made a lot of money in this candle and are still holding on to their contracts. And even though there was a little scare here, which is why I drew a line at this 516.5, I don't see a valid reason to take a put until we break this. We even possibly get below VWAP, but keep in mind your risk to reward. Will it come all the way back to the 515.50? I doubt it. Not during market open. I do believe that she will come where she came. And actually, I had my profit target wrong. If I would have picked it up and opened it up, I drew the profit target here.
NBC.
When it actually
Let's get some final thoughts as we count
should
down
have
to
been
Fed Chair
right where
Powell's
it
press
was.
conference.
Because
Dave
here's the
Kelly,
candle
JP Morgan Asset
right here.
Management is still with us.
Now you
David, it
take
seems
that
to me the risk
and
is pretty
extend it.
low right now for the Fed
Bam.
to hold these rates unchanged, which is, we know what they did. What is the risk, though, of cutting potentially too
Right
early? Is the
there.
bigger
That
risk
should
a
have been a
chance of
profit ticket.
reigniting inflation?
So I apologize for that. I had the wrong area, but it came right to the area. Because initially this was intraday supply for today. This was intraday supply. So for it to come back down to supply and then turn supply into demand is explaining exactly what's happening now. Now all the bears who were involved, they're covering now. The bears are getting squeezed. That is explaining this move.
Pretty slow. So I'm wondering, is there an immigration component to this? That they're thinking we're getting a lot
This
of
is a
immigrants,
squeeze move.
maybe coming in a very chaotic fashion, but adding to the labor forces, that's what's pushing up their growth targets. Is that why they think this economy is capable of growing this strongly without actually pushing up inflation?
You mean growing to that 2.1%, the GDP marker?
Yes, exactly, because that's above their long-term estimate of economic growth, and why they think we can do that. I mean, I think we can, but I'd be interested to know why they think we can do that, given their sort of previous calculations on the issue. Let's talk a little bit about quantitative tightening and what and where. I mean, Rick sort of gave the idea that wherever they stop, they're going to be higher than they began in terms of the size of the balance sheet.
Yeah, I think they are. I think they are, and I think that's because they've got such a complicated web in their ample reserves regime. They've got all these regulations on the banks.
So the report came out that interest rates are staying pretty much the same.
What individuals do
We
in
saw
terms
the
of holding
market
currency.
respond
It's
to that.
extremely complicated for them to figure out.
I think I'm going to go ahead and take the money and run,
View is, and Chairman Powell has said this, is they want to
and
stop before they
regroup
reach
with everyone
ample.
tomorrow
And since they don't
morning.
know where ample is,
God
they're
willing.
likely to stop short. So that's actually good news for the bond market. It means there's a lot of support from the Treasury Department, from the Federal Reserve in holding down those long-term interest rates. But it's good for the bond market. I don't think it has much impact on the economy overall, though.
We're seeing a lot of the bank ETFs jump, so the KBE is higher by more than 1% here. Obviously, they do well in higher interest rates environments, but the Fed is still holding steady on the idea of 3 potential rate cuts. So what do you think, why do you think the market is so excited, at least in the financial bank sector, to see what we've heard so far?
Because what we've got is patience and predictability. The beauty of 3 rate cuts is you do it in June, you do it in September, you do
What
it in
is
December,
happening
you do
is
it in one of these
exactly
meetings where you
supposed to
release
happen.
a summary of economic projections.
Squeeze
People can kind
move.
of figure out what you're doing.
Let's measure
If
the
they've gone to
move
2
so
rate
we
cuts,
know where it's
then
going.
there's a lot of uncertainty. Was that July? Is that September? Could this all vanish? So long as they are patient
56.
and consistent in what they do, that I think helps financial markets in general.
So do you see 3 cuts this year beginning in June or what?
Right
Yeah,
there.
I do. I think they
That's
will
where
have
it's
enough
going.
evidence in underlying
Right where
core
it
inflation
is.
coming down by June to justify a first
That
rate cut.
is a
Because remember, we're
squeeze
very
move.
tight.
That is
And I think
exactly
they can give
where
us
we
another
are.
rate cut in September, another one in December, and then we'll see about 2025. I think they can keep going for a while here, but I think they'll just wait for the evidence. But I think they'll have enough evidence in June to start this process.
And as you say, you're not concerned about a rate cut reigniting inflation.
No, because this economy is actually pretty good at growing at a solid pace without causing inflation. We've had inflation come all the way down from 9.1 to 3.2 without economic growth slowing down. We've had 27 months with the unemployment rate at or below 4%, and yet inflation is still basically being cut to a third of what it was back in June of 2022. So this is a pretty impressive economy, and I think the Fed can kind of do its thing here, and that's, I think, good news for everybody.
All right, David Kelly, thank you very much for your time today. We don't have Chair Powell yet, but why don't we just take a look at where the markets stand right now. The Dow and the equity markets have basically gone from flat to what I would characterize as a very modest gain of about 0.4% for the Dow, a little more than that for the NASDAQ, and a little less than that for the S&P 500. The 10-year bond yield at 4.29%, and there you see it dipping earlier today, now back up 4.29%, 4.27 or thereabouts. Here is Chair Powell.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and
Now we
demand
want to see a
conditions continue to come
continuation,
into better
guys.
balance.
We want to see a
Over the
continuation,
past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and
Less than
a
10
continued
seconds
strong
left in this
pace of
candle.
immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation.
There it
The
is.
median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year.
Be patient. Be patient.
Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%.
I just want to double check. Is
Longer-term
anybody
inflation
in a trade right
expectations
now?
appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2%
It's in a trade right
2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance.
I don't think so, Lance.
Our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin.
We got the close, but we did not get the continuation.
At some point this year. The economic outlook is uncertain, however.
It started off looking like a continuation candle, but it flipped from red to green.
We are prepared to
I hope you're not heavy in it.
Target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has
We use the VWAP as
confidence
support and
that
bounce.
inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate
Yeah, I apologize, Lance. I knew I should have got off.
In particular, slowing the pace of runoff will help ensure a smooth transition,
time to
reducing the
run.
possibility that money markets experience stress, and thereby facilitating the ongoing decline.
But knowing
in our
that this is
securities
still going to be a
holdings,
whiplash
consistent
type
with reaching the
day.
appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the
Is
long term.
everybody else safe?
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
We got it. Get the continuation.
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger.
Again, this is going to be a roller coaster. So let's go ahead and end it now. And all unfinished business we can deal with tomorrow. How does that sound? Can you hear me now? I was saying I want to go ahead and end it now. All right, awesome. Can you guys hear me? I said I want to go ahead and, okay, yeah, I want to go ahead and end it now. And all unfinished business we can take care of tomorrow, God willing. Thank you guys for showing up. This is some real change stock options trading journey. We'll see you tomorrow at 9:25, God willing. Bye for now.